What types of business loans can you get with bad credit? Every business needs funding, and you may need to turn to loans to help fund your business at one time or another. Unfortunately, you may not have the sterling credit required to receive a loan from a bank with favorable terms and low interest rates. If your business doesn't qualify for a bank loan, where else can you turn? There is an entire industry of alternative lenders that aim to fill the gaps where banks are unwilling or unable to lend. However, accepting money from alternative lenders requires you to be savvy, or you could dig yourself deep into debt. What types of business loans can you get with bad credit? If your credit history isn't good enough to obtain a loan from a conventional lender, there are other types of financing, often provided by alternative lenders or private lenders. While the flexibility and speed with which these loans can be approved are useful if you have bad credit, the terms can also be restrictive and the loans expensive. Should your current credit score fall within the fair or poor ranges, these are some of the most common loans available. Short-term loans. Short-term loans include term loans that are repaid in 3 years or less and lines of credit repaid within 1 year. If you have good credit, you would ideally leverage short-term loans because of their low cost and easy approval process. Should your company have credit issues, short-term loans can be useful, because lenders often prioritize cash flow over credit score. So as long as you have enough revenue and reserves to support a short-term loan, a lender will likely approve your application. Hard money loans. Hard money loans include several types of loans that are backed by a collateral asset rather than a credit score. Most often, the assets used as collateral are real estate, such as a building or plot of land. A bridge loan, for example, is a type of hard money loan that is often used for redeveloping a property. The loan is secured by the value of the real estate upon completion of the project, allowing the lender to foreclose on the property if you default on the loan. Invoice financing. Factoring, or invoice financing, isn't truly a loan. Rather, you essentially sell your accounts receivable to a factor at a reduced rate, typically 70% to 90% of the total value. Invoice factoring can be useful if your business is seasonal or when you need growth capital. However, using this option to cover operational expenses is a risky maneuver.